dividend policy, an overview of it, why it doesn't matter, and why it does matter. If you were ever asked, why might it matter? Because as a financial manager, you want to know, does dividend policy consistently affect the value of a firm in a way that we can predict? So should the financial manager be concerned about it? Does it impact on firm value? That's the question. So fundamental question is, does dividend policy impact on firm value? All other things being equal, can you think of a good dividend policy or a bad dividend policy? Whereby if two identical firms, one has a good dividend policy, it would be valued more than the identical firm with a bad dividend policy. Does dividend policy matter? So a lot of guys out there earning a lot of money as corporate financial managers arguing that it does. What you need to know as a future manager is, does it? And what are the correct questions to ask? People are advising you what to do with dividends. So hopefully the training, whenever you get confronted with this question, you immediately think of the day Ireland qualified for the European Championships was the day I was sitting in my MBA lecture, and the lecturer told me, whenever anybody asks you about dividend policy, your bottom line is Medigliani Miller. You must be agnostic and say, I don't believe it matters unless somebody can convince you why it does. That's the healthy position to adopt. Now, there's another reason why you might need to be concerned about it. It's not just whether it affects firm value, it may do so kind of indirectly by impacting on capital budgeting decisions. So when we did our NPV and capital budgeting, we did not consider where we were getting the money. We just asked, does this project deliver a positive cash flow or a good NPV? Does it pass the hurdle rate? Does it pass the payback period method? We never asked, where are you getting the dough? So we separated the investment decision from the financing decision. Like you're going to buy a new car. What type of car are you going to buy? Oh, I don't know. Am I going to pay for it with a bank loan, or am I going to pay for it with retiring some super, or am I going to pay for it by cash? That will determine which model I buy. Do you think that sounds intuitive? Similar types of questions. So is it true that a good project is a good project regardless of how it's financed? What if the valuation of a project does depend on where you're getting the money? And so one possible way where dividends could matter is if you're considering capital budgeting in a tax regime where you know that shareholders are going to prefer dividends to capital gains because the taxation of dividends is less than capital gains, then it could be that using some retained earnings rather than paying out dividends to finance a project could enhance the value of the firm by making the shares more attractive to investors from that locale, that tax. So there's an example. But you see what's happening? I'm talking tax. I've departed from Modigliani Miller. Yeah? I'm going to first show you very quickly the intuition of the Modigliani Miller theorem. And it's one slide, I think. So this summarizes what I'm saying. 3 views. Predictably, in the world of Modigliani Miller, it doesn't matter. In the real world, higher dividend payouts could raise firm value if they are important to shareholders, and lower dividend payouts could raise firm value if capital gains are taxed at a lower rate than dividends. If capital gains tax are taxed lower than dividends, it means dividends taxed high, so don't pay dividends. Keep dividends low. Okay? And so it's like Ryanair, whoever's doing Ryanair, the team is doing Ryanair. So they say, you know, we don't often give dividends. You get your income on the capital gains. Let's think about types of dividend payment. Cash dividends. Now, this slide just it gets me to deriving the Modigliani Miller irrelevance. Let's think about how a firm is going to give its dividend payments. Cash dividends. This every quarter or every year the firm pays some cash, hard cash, sends it out in a check to each shareholder. So if you're going to buy the shares before the dividend or with dividend or just after the dividend is paid, it's ex-dividend, etc. So that's cash. You're going to pay hard-earned corporate cash, pay it out. The second way you could do it is stock dividends. So instead of giving hard cash in the envelope to each shareholder, you give them some more shares. So you send shareholders some extra shares. For example, each 10% stock dividend would be giving an additional share for every 10 held. Yeah? That's a share dividend. But can you see what's happening? What the firm is doing is just like printing money. It's just increasing the number of shares outstanding. So a bit of little corporate magic going on. It ain't cash. It's a stock dividend. And so really, it's saying from our lecture now, I think I can see lights going on. That whatever the earnings of the firm in the following year, whatever leverage it has, it's going to the payout to the stockholders now is going to be diluted by the fact that there are more stocks. So stock splits are similar to stock dividends as far as they raise the number of issued shares. For example, a 2-for-1 stock split is just where the firm just doubles the number of stocks. So for every stock that you have, they give you another one. And so then the opposite would be stock repurchase. You'll be aware that sometimes when the firm says, okay, we got a lot of spare cash. We're not going to pay dividend. We're going to buy up our own shares. And so, does any of this stuff impact on the value of the firm, or is it all just wizardry? Believe it or not, I've got a company. So it's a campus company called Troat. Campus Company Limited. This is not its actual books, but it's an example. We have Troat. You can look it up on the interweb. It's spelled like that. It's a pretty boring company, but anyway. So anyway, so here's a balance sheet where we've got assets and liabilities. It's more like a traditional accountant's balance sheet. Suppose it has 100,000 shares at 10 each, amounting to 1 million. A cash dividend of €1 per share would be 100,000. A stock repurchase of 10,000 shares would be 100,000. How would that look in that balance sheet? So the cash dividend, before the cash was 150, and now we take 100 of it. We pay it out, we send it out in envelopes, so we only have 50. So we're 900, the value of the company's gone down. And we did have 100,000 shares outstanding at a tenner each. Now there's 100 shares outstanding at 9 each. Agreed? We've taken some value of the firm and given it out. Gone from 1 million to 900,000.
Why did the equity change? The equity remains the same. If you paid the dividend, that's kind of interest on the shares.
Because the equity is calculated as the because the value of the firm has gone down to 900. So the value of the firm is the value of its debt and the value of its equity. So given that we've taken out of the balance sheet 100,000 and given it back, we've downsized the firm effectively. So the value of the equity has gone down.